Before you start your journey to homeownership, you need to understand how credit pulls affect your score. In this video, I've come up with 3 key things you must understand when you're going through your homeownership journey, so that way you know how it's going to affect your unique credit score. And if you stick around to the end of the video, I have a couple of bonus tips that are going to be extremely helpful for your journey. The first thing we need to talk about is going to be the different scoring models. In this, you'll see one of 2 options. You could see a FICO score or you could see a Vantage score. FICO stands for Fair Isaacs Corporation. When getting your credit pulled for a FICO purpose, you will typically have about 45 days to be able to shop around with different lenders to be able to find out what are the best rates and options available to you. What this allows you to do is have your credit pulled by multiple different places and only have one of those credit pulls affect your credit score. Your FICO score could range anywhere between 300 to 850. Obviously, in this range, the higher the score, the better your credit is. The specific use case for a FICO score is going to be for things like a mortgage, an auto loan, or even a credit card. And with FICO scores, they are predominantly used with the 3 big credit bureaus. This would be Experian, Equifax, and TransUnion. The thing to understand with FICO is there's actually even different versions within it that could determine what they use to score you. So for example, you may see different things with your scoring system that says your FICO score 2 is one number, but your FICO score number 4 may be a completely different number. If you're wondering which score to use to get a better idea of where you'll be for mortgage purposes, they're typically going to be using FICO score 8 to be able to identify your mortgage credit score. Now let's jump over and talk about the Vantage scoring system. When it comes to Vantage, this is actually going to be a shorter window when you are shopping. Instead of you having 45 days like you did on the FICO side, when it comes to the Vantage side, you will only have 14 days. The thing to understand here though is with the Vantage scoring system, this is actually not used for mortgage purposes. Typically, if you are getting a Vantage credit pull, this is going to be for things like a personal loan, insurance, or even possibly things like utilities. So if you're going through the mortgage process, you shouldn't have to worry about only having a 14-day window because they're not going to be using the Vantage scoring model. While Vantage scores are becoming more popular, it is less universally adopted specifically by mortgage lenders and mortgage brokers. Vantage scores do also use the same tiers with regards to your credit between 300 and 850, just like FICO does as well, but this is going to be more commonly used for credit tracking than it is going to be for credit pulls. For example, if you are looking up your credit on something like Credit Karma, Credit Sesame, and some of those other online apps that allow you to be able to track your credit, you're more than likely not looking at your FICO score. You're actually more than likely looking at your Vantage score. What this means is typically whatever score you see on the Vantage side is more than likely going to be about 15 to 25 points higher than what it would be on a FICO score. So for example, if you have a Vantage score in front of you and it says 700, more than likely you could actually be seeing your true FICO score be about 685 and possibly even 680 depending on your unique situation. Keep in mind, these are just averages of what I've seen in the past with credit scores. I've seen it actually be less of an effect. For example, it only being maybe 5 points lower or even close to exact, but this is just something I've seen based off of historical experiences I have helping different families and veterans go through their homeownership journey. The second point we need to understand here is the long-term effects. While your credit score might dip slightly due to these inquiries, the overall act of shopping for a mortgage typically indicates that you're in a good financial position. Now, don't get me wrong. This is not me saying you should go get your credit pulled all the time, which means as long as you're acting within the grace period, you have the ability to shop freely. For example, when you are looking at your credit score, there's actually 5 different tiers that make up what is affecting it. The most important component of your credit score is your payment history. This makes up 35% of what your score actually is. The next component is going to be the amount that you owe. This will make up 30% of your score. The amount that you owe is essentially your credit utilization. And what they're looking at is what your balances are for typically things like revolving debt. And then what they're weighing it against is what the overall limit may be. For example, if you have a credit line that allows you to use up to $1,000 and you have that credit line maxed out, this can look more negative against you, even though it's $1,000 because you're using up 100% of that utilization. But if that credit line is $1,000, but you're only using $100, you're now only using 10% of that credit line, which means that it's not going to have as much of a negative impact on your score. The next component is going to be the length of credit history. And this actually only makes up 15% of your score. With credit history, what they're looking for is how long you've had particular trade lines, specifically things like revolving debt. If you have credit credit cards and you're constantly closing a credit card, this actually can have a negative effect on you because you're not allowing it to show age on your credit and show consistent on-time payment history. But if you've had a credit card for multiple years, I would say anything more than 2 to 5 years, this could now have more of a positive effect on you than you having something for only a few months. After a length of credit history, the next one is going to be credit mix. And credit mix is essentially you having multiple forms of different credit types. This could be for things like auto loans, revolving debt, installments, and so on. This makes up 10% of your score. And then the last one is going to be new credit. New credit makes up an additional 10% of your score as well. But within new credit, this also is the factor where they will use the times that you are getting your credit pulled. So as you can see, credit pulls are only a portion of your credit score, and it's a small portion. It's only 10%. So if you are seeing drastic decreases in your credit score whenever you're getting your credit pulled, more than likely there is something else going on with your credit profile that's causing your scores to see drastic decreases. It's not just going to be from that particular mortgage credit pull. Now, don't get me wrong, too many credit pulls outside of the grace period can start to compound, but it's not necessarily going to be the cause of the overall massive dips that I've heard people mention that they've experienced in the past. Which leads us to our third point, and this is going to be the temporary nature of a credit score drop. The drop in your credit score from a hard inquiry is usually temporary. While sure, it may show up on your credit report that you had a hard inquiry, for most people, scores recover within a few months if you have no other negative effects. So even if you see a slight decrease, it's not usually a concern unless other factors come into play. Now the fun part, let's talk about the bonus tips that I have for you guys. The first one is going to be using a soft credit pull. At the pre-approval stage, ask the lender if they can do a soft credit pull instead of a hard credit pull. The reason this is important is because it allows you to be able to only have a soft credit pull done where it does not actually affect your credit score, and it allows you to be able to freely go and shop for homes that fit your family's needs. Now keep in mind, when you do find a property and you're ready to go under contract with that property by making an offer, then the lender will need to do a hard pull, but that allows you to at least get a property secured before actually committing to the act of doing a hard credit pull. This strategy minimizes the exposure of your credit score to unnecessary hits. And then my last tip, instead of getting your credit pulled by multiple different lenders, consider working with a mortgage broker. You see, a mortgage lender is essentially going to have one product offering, which means that you are at the place in which you will get the deal from. But if you are working with a mortgage broker, they have the ability to shop around for the best rates and the best terms that fits your needs without you having to do multiple credit pulls. So essentially, you only need to do one application and one credit pull, and then the mortgage broker can actually shop your application around to different mortgage lenders. This can save you from the potential hassle of multiple hard pulls and overall just preserve your credit health. So those are my tips around what you need to know with getting your credit pulled when you are going through your home buying journey. The last thing I want to leave you with, which is the most important thing, Jesus loves you and he paid the ultimate price for your life. So if you turn to him, trust in him, and believe in him, he has a beautiful plan and purpose for you. I'll see you guys in the next one.